So I've written two papers on fractional gold price disparity theory, and I'm going to read from the longer one right now. I don't know how long this is going to take me, but one of them I kind of put in a bullet point fashion, and I agree with the points that I wrote still, even though I wrote a little while ago, but I think that the longer one has some more interesting, more well-developed theories within it. So here we go. Gold premium disparity theory. This is about when premiums on coins, gold coins, like a 1 ounce or a tenth of an ounce, don't rise proportionately with a rise in the price of spot. The spot price of gold is determined by the exchange of 400 troy ounce good delivery bars, which are bars certified by the London Bullion Market Association of approved refineries, in the current market worth about $500,000 each at current prices. These are purchased by the ultra wealthy, either investment or wealth management companies, banks, large corporations looking to hedge their bets on the stock market, or even wealthy individuals with enough money to buy directly off of the stock market, something unthinkable for most people. When spot rises due to the exchange of these bars, but premiums on small 1 ounce or even 10th ounce gold coins don't increase, it means that the wealthy, whether it's individuals, corporations, or banks, etc., feel that their outlook on the economy is worse than that of the average or middle class person. This is a signal to the wise that there is something going wrong in the economy which the average person is not tuned into, which means this is a precipitating factor, could be, of an oncoming recession. This is the only rational explanation, because if the people at the helm of the nation's economy sense that the economy is about to take a hit, but the average investor or person isn't increasing their reliance on hard assets such as gold, that means that the crowd of people in the know, if you will, on coming legislation that could affect the economy or corporate mergers or even bubbles in entire sectors, whether it's real estate, the dollar, it could be any traded commodity whatsoever, they know something that is making them nervous about the future of the economy, either in the short term or medium term, up to 3 months or even up to 5 years, respectively. When you juxtapose these perspectives, it can mean only one thing: that any disparity in the prices being paid for gold, precious metals, or hard assets on different scales implies that the respective customers at those different ends of the spectrum have fundamentally different views on their economic forecasts. If spot falls, but small coins like a 1 ounce or a tenth of an ounce maintain similar or equivalent price levels, then one could surmise that the wealthy are simply reallocating their wealth into short-term preferred investments, which are likely to profit them if they have inside information, or given the magnitude of their wealth, they are able to buy into companies which the average person couldn't afford, such as Berkshire Hathaway, which is hundreds of thousands of dollars for a single share, just for example. But that for the average person or investor, their outlook on the economy hasn't improved, and they don't believe the systemic issues affecting the economy have been altered or moved in a better direction. Gold can trade up or down, even sideways, and it's always good to know the difference in perspective on the premiums being paid between the wealthy and the average person, because it's a sign of disparity between the thought processes used for the wealthy compared to most people. Keep in mind that the goals of the wealthy and stock trading crowd are different from most people. Most people simply want a reasonable, consistent, long-term wealth plan. They don't care if they end up billionaires from their investments. They just don't want to end up poor. But the stock trading, investment, billionaire crowd, they're in a constant frenzy, a race to the top, to end up in some list in Forbes photographed standing on a red carpet in expensive Italian designer clothes. It's a vain pursuit of materialism and transitory wealth, which, when juxtaposed to the meager desires of the average person to simply have something that can constitute their retirement nest egg, makes it clear that although at the moment the wealthy don't have their money in gold or silver, the reasons substantiating the value in precious metals have not disappeared or been assuaged. And by the way, I was just kidding. It was just a little subtle attempt. I got nothing against people who want to have Italian designer clothes. Suppose gold spot falls dramatically like it did from around June of 2015 to December of 2015. Over a 6-month period, it dropped from about 1,200 an ounce to about 1,060 at the bottom, or roughly 12% in value. If you look at the prices paid across the board for bullion coins, or coins that trade for nearly bullion prices, like common date pre-1933 gold coins, the prices from dealers and large volume sellers out there like APMEX, JM Bullion, Provident Metals, etc., didn't really drop below approximately 1,200 an ounce, and proportionately so for smaller coins, although typically the premiums were a little more, for the most part, except for damaged coins and a few anomalous ads on eBay and elsewhere. That means that the average gold buyer or coin collector has put a price floor of somewhere around $1,175, $1,200 for most double eagles. And this makes sense given the disproportionately large demand for $20 pieces over smaller $10 and $5 pieces, whose floor seems to be decidedly more spot proportional. This shows to the discerning observer that although gold spot fluctuates, there is consistent demand for larger pieces of antique gold. Other types of gold coins, such as gold eagles and generic rounds, tended at that time to track more closely to spot, especially privately minted rounds and bars. However, even those showed resistance to dropping prices, many sellers dropping entirely out of the market, refusing to sell precious metals given the downturn. I remember walking into pawn shops and local stores that advertised that they buy and sell gold and silver bullion and coins, and when I asked if they had any gold coins, many of them outright said to my face that they refuse to sell in the current market due to the low prices. This reflects the principle of the inverse correlation between price and supply, which is an interesting subject all its own, and I plan on making a video about that as well. But anyway, and I'm bringing this up at all because these subjects overlap when discussing the bear market aspect of price disparity theory on gold spot. However, now, to contradict an earlier point, but only slightly, when gold spot dropped at the time, although there was resistance to a drop in the sales price, the premiums over spot grew immensely. And when spot came back up, certain coins, such as commemorative gold coins from the 80s, of which millions were made and are very common and extremely high grade, there's really nothing special about them. While their gold value rose, their premiums dropped. Some people mistake and conflate premiums for overall price levels, and that's confusing two different components of the market value of the commodity. The premium is simply the additional price over spot that dealers and sellers charge in order to cover their costs in handling the coin. And it reassures sellers that they got the best possible price for their coin, which if they could not get such assurance, they would not have brought it to the market in the first place. People tend to not liquidate their assets, investments, family heirlooms, or what have you, unless they believe they are getting the most they possibly can. So as a buyer, it's always best to pay a small, reasonable premium, because it's better to have what you want at a slightly overinflated price rather than not have it at all. I mean, if you want it. Also, when you pay a premium to a dealer, it sort of acts like a form of insurance, because supposing the current coin turns out to be fake or not as described, dealers have reputations to protect and businesses to keep safe from litigation, so they're inclined to give you a refund as soon as possible. Whereas any situation you come upon where a seller is liquidating for gold for spot is most likely not going to offer any kind of guarantees or refunds. That's another concept I'd like to expound upon in another video later, the correlation between premium to guarantees and warranties. And in the context of the current subject, the relationship extends into at least one arm herein, that of the scarce outlier occurrences of gold trading for suspiciously low prices when gold spot dropped over the aforementioned period. So in conclusion, the perceptive gold buyer or precious metals investor is always keen on the disparity between the prevailing mindset among Wall Street traders and the average middle-class individuals, not only as a sign of the short-term alternative investment opportunities such as a new tech company or pharmaceutical product, etc., that could be pulling money away from gold, but not actually changing the reasons to buy in if you're an average person, but even so far as a precursor to another recession. So there's a whole range of reasons for why that could happen, why spot changes, because the spot price is dictated by the wealthy for the most part. So that's the first paper I wrote, and the other one is kind of a bullet point font kind of deal, and it's about fractional gold as well, but it focuses less on the reasons for why the spot price changes, but it's not equivalent at different levels. This one's more about the practicality of it for lower level investors, people who have less than 5,000 or even up to 50,000 to invest. If you got 5 million or more to invest, well, you're probably talking a different kind of investment. But most of us at the lower level, we're focused on different kinds of coins or different kinds of gold, different kinds of silver. So here's the second paper. Fractional gold is much more desirable. Oh, and this is a rough draft, by the way. This is just something I wrote out for my own thoughts. Fractional gold is much more desirable than 1 ounce rounds or larger bars because in trade, the premium as a percentage is virtually always higher than 1 ounce. Many people interested in gold can't afford a full ounce at a time. And so fractional in a barter situation holds the value of gold, yet it moves with the liquidity of silver. The size of a coin makes it easier to store and transact. 1/10 of an ounce is about the size of a dime, and 1/2 an ounce is bigger than a quarter, but smaller than a $half. If you believe that and here's the most important thing, this is my personal bet. If you believe the long-term trend for gold spot is higher prices, say $5,000 or $10,000 an ounce in time, which may be possible since gold used to be only $20.67 an ounce, and now trades on APMEX are about $1,400 an ounce for 1/10 of an ounce rounds. 1/10 of an ounce coins are going for $1,400, almost probably even $1,500 an ounce for Krugerrands. And I think I think they're even trending higher than that now for 1/10 of an ounce. Then the principal benefit of marketability for fractional compared to 1 ounce coins increases as the spot price of gold increases when buyers compare the two price points. Because and that's not about in terms of premium, that's just about the buy-in cost. Would people rather have some wealth stored in gold, even if they can only afford $200 to $400 at a time, and not $1,000, $5,000 at a time? Well, yeah, people would rather have that. And that's kind of what I'm getting at here, is that you're banking on that. You're banking on lower, I'm not saying lower income people, but just with people less cash liquid. Plenty of people have hundreds of thousands of dollars in net wealth. They've got it in their home, they've got it in their cars and various investments, even family heirlooms, the stock market, etc. But they don't have a lot of cash liquid, and you're banking on temporary fear, essentially, or even a rise in the general economic condition, the fear that economic conditions are getting worse. That's what you're banking on. It's a bet. And it's kind of a pessimistic bet. But if you really think the dollar's going down, well, then this is the bet to make. So as the spot price of gold increases, the price point differences puts you in an advantage over people who are heavily invested in 1 ounce or even those 10 ounce bars. Like, whoa, you don't want to be stuck with that. Marketability for fractional also increases as the spot price of gold drops, because as a 1 ounce round becomes more affordable, most local dealers, this is another interesting phenomena about fractional, most local dealers and small dealers, I'm not talking about bullion dealers, I'll get to them in a minute, like APMEX. These are two different things. The brick and mortar people are different from the online large volume sellers. Most dealers will have price inertia with fractional rounds, and you as a seller can undercut their prices but still get above spot gold price. What that means is, even as, let's say, gold right now is like $1,260, $1,270 an ounce. Let's say gold goes down to $1,150, and a lot of dealers bought in those 1 ounce, the quarter ounce, let's say they bought the 1/10 of an ounce coins, and they bought them from the large volume sellers, or they bought them from somebody else and were trying to sell them locally for $150 or $160 each. Well, they're not going to drop their prices. The amount of money that they have in the coin, it's not going to change, so they're not going to take a loss. Local dealers, the local economy, that's what most people it's going to be based off of, unless you're dealing with people who are, the buyers are also online looking at JM Bullion and other dealers. And if you can undercut them too, well, then great. But let's say you had to sell, like you had a better investment, something at the time that just seemed like it could make you more money, or you had a bill to pay, medical expense, whatever, you needed money, or you just wanted to get your cash out of it. Chances are, if you tried to sell the 1 ounce coin, you would lose more money, because if you had 10 1/10 of an ounce coins and you had bought them in at, let's say, the current going price of those coins is probably on the internet $140, $150 a piece, more than that even in other places. Certainly local dealers. I've called up local dealers and they want like $155 a piece. Like, whoa, no thank you. But if spot were to drop, well, you're going to have a lot of people who'd be willing to pay you spot straight up at the time. And so let's say there were people who wanted to get those coins, and you're not willing to take spot. You always want to get as much as you can, right? I mean, it's an investment. Well, even if spot drops, you could still probably get 1,300 an ounce, even 1,350. You're not going to get as much as a dealer. Probably not, although you might. But if you can just undercut the local dealers, but still be above spot, if you put in 1,400, then you only lost 50, even though somebody who had a 1 ounce coin, they lost it going from 1,300 nearly, although they probably bought it for 1,300. Well, now they're only going to get 1,200 because the buyers who are buying in at the greater price levels have more money to spend. Whereas if you sold off those 1/10 of an ounce coins one at a time or even all at once, the premium difference, I've personally witnessed this. You can get above spot, and I'm talking like $100 above spot or even more. You can get a substantial premium over spot. And so even though gold spot goes down and you think you just lost your ass, you didn't. You either don't lose as much, you might not even lose anything at all, depending on the price that you bought in at and how much premium the local market will allow. Because if you're living in an area where most people aren't looking for gold or they don't really care, or they don't have the money, well, then you're kind of in a bind. Then you're going to be going off of what the dealers are willing to pay you, or you can sell it for online or whatever. But if you're living in an area where there's a lot of local demand, it's always good to know what the local market is like. If it really is like within a 5 or 10 mile radius, if it really is very hot, like a lot of people want gold, or if you're living in an area where people don't have cash liquid, they're not looking for gold at all. Or you're living in Detroit where a lot of people don't have any money. Some people do, but a lot of people are bankrupt. And that's kind of my point here, is that as spot drops, it's advantageous to have 1/10 ounce or any fractional coins, because compared to 1 ounce coins, whether spot goes up or down, you don't lose as much as somebody who's heavily invested in the 1 ounce or larger. Because somebody who's got a 1 ounce coin, let's say they ever wanted to liquidate it, they're probably going to end up just getting spot anyway, because it's so expensive. A gold eagle, let's say gold spot was $12.50 an ounce. If somebody bought it for $13.20 or $13.40, 70, 90 bucks above spot, give or take, somewhere around there. A lot of dealers charge that. Not quite 100, though some do charge 100. But let's say it went up that much, or let's say it was $80 above spot. If they had to sell it like a week later and spot hadn't changed, they're probably not going to get more than $12.50, because so many people who even have $1,250 cash liquid, they're not going to give you any extra money. They're not going to do that. They know that if you go to any coin shop or gold or bullion dealer, they're probably going to offer you like $1,000, $1,250. They got to make their money. And so they're not going to give, if you're even lucky, they might offer spot. But most people, they're going to offer you spot right at the time, maybe an extra $20, but you're going to lose something probably if spot hasn't changed, unless the local market has changed, because gold demand is very regional. It's very sectional depending on where you live. In the South, where there's a lot of Republicans, where there are a lot of people who they don't like Obama, they don't trust the economy, they just don't think things are good. They want gold. Older people who want economic stability, some of them want gold. Some of them are selling gold that they bought a long time ago, etc. It varies person to person. But in general, it depends on where you live. And so if you're living in an urban area somewhere up north in a liberal city, chances are there's not going to be a whole lot of gold demand. I mean, it does depend. I've had different people tell me different things. Like if you're living in New York, like there are plenty of coin collectors up there, but not a lot of people heavily invested in one thing or the other. There are people who will buy gold, but it just varies depending on where you live. It just varies. So it's always good to know what the market's really like locally. So I hear that Florida has a really high amount of people that they want old gold, like antique gold. I've heard that. It's one of the last states where you can really find lots of coin shops that really are selling like pre-1933, often buying and selling. I've heard that, but I'm not an expert on that for the Florida coin market. I don't know. I'm in Texas. So, but anyway, my point here is that as spot goes up or down, you can bank on the price inertia factor from local dealers. As long as you know the local market, you're good. And it's always great to sell something for cash because, well, then you don't have IRS problems. Unless you put that cash in the bank, and then you're going to get IRS problems. So, and this is also one of the great things about buying gold eagles is that there's no tax on them. Yeah, a lot of people don't know this, but above 25 troy ounces of gold, you have to file what is it, a 1099 with the IRS or something if you profit. But I believe that gold eagles are just completely tax exempt. If you buy gold eagles for like $1,000 and sell them for $1 million, there's no tax, as far as I know. Not any special tax on the gold. There might be like income tax of just separate general income tax, but you probably have to talk with a tax expert on that. But that's one of the cool things about gold eagles, just as a little side. So, tenth of an ounce coins, over 1 ounce coins. This is what I put. Ultimately, fractional gold is really the best kind of gold to have. You can still have it in quantity, but even in small quantity, whether gold goes up or down, if you ever decided to sell, you won't be subject to the same limiting conditions that those heavily invested or 1 ounce rounds or bars or even 10 ounce are, with both regard to premiums and finding people with liquid cash in quantity often. And this is one of the other things. Let's say you had a 10 ounce bar. Let's say you even had that much money, which some people might. So in the current market, what would that be, like $12,500, almost 13? Probably cost you 13,000 for that bar. If you bought that bar, how many other people have that much cash to buy that bar? Probably not a lot. Probably not too many. Most people don't have like $10,000 to just spend on something that just sits. Even if they think, or even if you think it's a good investment, not a lot of people even have that much money to just put into something. So if you were to even believe that gold spot's headed to 5,000 or 10,000 an ounce, and now your bar is 50 or 100 grand, well, hey man, if people didn't have money at $13,000, how many people have $50,000 or $100,000? And that's my point, is that it's better to have the 1/10 of an ounce, because then you're talking only $500 a coin. And even assuming that price change would be precipitated or necessitated by hyperinflation or even just strong inflation. I mean, we've all seen gold go from 20 to 35 to 1,200 to almost 2,000. I mean, we've all seen it. And if you haven't seen it, then you can just look up a gold spot price chart. And yes, it's taken decades, but still, that's a lifetime. That is, I mean, it's if you think the dollar's headed down over the course of your lifetime, then you want to be betting on something that over the course of your lifetime will at least hold its value, if not grow. So the 1/10 of an ounce, if you think gold's 5,000 or 10,000 an ounce, I think it's even this is what I was getting at. Even assuming inflation, it would still be better to have it, because you can't bank on or bet on most people having that $1,000 or more, or the $10,000. You can't bet on that. You don't want to bet on that, because in an inflation-based economy, just look at Germany in the 20s or America in the 70s. Inflation. A lot of SNL skits came out in the late 70s about inflation. And the reality is that some people will get very wealthy in a bull market on money, on just money itself. Some people will get very wealthy off of that, but most people won't. Most people will lose their wealth. Just like when gold was confiscated in 1933 and it was traded for paper dollars, when you take away the value inherent in the dollar, what happens is the purchasing power drops. And so it takes more and more. I mean, obviously, just to buy an ounce of gold went from $20 to $35. And that's kind of the issue here, is that how do I put this? If gold's headed up due to it depends on why you think gold's headed up. If you think gold's headed up due to inflation reasons, fear of the dollar, then you're really betting that the average person's wealth is not going to increase correspondingly so with that inflation. Maybe a few people, like I said, but anyway. But overall, just to get back to my conclusion though, with regard to premiums and people finding, and problems with finding people with liquid cash in quantity. You might find one guy for your 10-ounce bar at $100,000 maybe, but that's probably just one guy. And if he offers you 95,000, well, what are you going to do? You're going to say no. He's the only guy with that much cash on hand. And so if it comes down to how much time you have to put in to the sale. If you can wait 6 months or something, like you don't even really need to sell it, well, then okay. But if you got like 1 week or 24 hours or something, well, then it's gonna be whatever offer you get. So ultimately, with 1/10 of an ounce or fractional gold, you'll have more freedom and flexibility than your competition, the people with a 1 ounce and larger, placing you ahead of the crowd. So anyway, that's just my personal summary on why fractional gold is a solid investment compared to 1 ounce and larger. If you agree, comment. If you disagree, comment. Hey, I'm all for debate. I'm all for discussion. Signing off. Thank you.